What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Happy Friday out there. Thank you for joining me. Today, we are going to take a look at Jay Powell and him guaranteeing rate cuts at Jackson Hole's speech. We have in the past watched a lot of Jay Powell on this podcast and on previous podcasts I did with Bitcoin Magazine called Fed Watch. And I like to break down exactly what he's saying, why he's saying what he's saying. This was a little bit of a shocker to some people, but overall, it just confirms that he sees the same things that we're seeing out there. And yeah, so we're going to do that. We're also going to take a look at the price charts a little bit and take a look at one of the posts I just put out today. So here we go. Let's share the screen and get into it. Of course, there's links down below in the description, and put your comments down below and I will take a look at the comments later. BTCP says, happy Friday. Happy Friday to you, man. Thanks for joining. Okay, so this is bitcoinmarkets.com. Check it out. Sign up free for all my content that comes out there. You will be getting one email a day, pretty much, with either written podcast or other things. So there's also paid tiers, of course. Take a look at the member tier. You can enter our price forecast competition each month for just the $5 level. And then the $15 level is to get my premium content, which I probably will get one out this weekend. Just kind of ran out of time here this week to do that, but that is coming up. And the price is acting exactly like I predicted anyway, so there's not much to update in that regard yet. Speaking of that, let's go to a live price chart. And I was going over this earlier with the guys on Telegram on our pregame show, so you guys can join the community there. Get about 5-10 minutes of extra over there. What we were looking at was this, specifically the breaking of the 50-day finally, and also just slicing right through the 200-day. And it looks like we're going to close above the 200-day. At least we did close that on the ETFs. So if we go to IBIT, you can see we're up above the 200-day moving or 50-day moving average. They don't have a 200-day yet. That's too new. But we're above the 50-day, which is important. If we take a look at CME, CME will close in 26 minutes. Have the 200-day. It's different for CME because they have different hours, trading hours, right? But it did break above the 50-day moving average, which is really important. And then back to the regular Bitcoin chart, you can see breaking above that 50-day finally. That has been resistance for a while, since this big dip back here on August 2nd. So pretty much 21 days, that was resistance. And now we have finally broken it. We also broke the 200-day moving average, which is significant. If we close up here, and it wasn't a weekend, like if today was Thursday, tomorrow would be a very big day for Bitcoin. But we probably are going to have to wait here. Now, it's not impossible that it continues to moon on the weekend when CME is closed and the traditional markets are closed, the legacy markets, but it's more unlikely. So right now, the next 2 days probably will try to consolidate above the 200-day moving average. And then on Monday, we should have a pretty big day. There's not much resistance, what I was telling these guys on Telegram. So we have this line. I just hit it. So let's bring it back up. This line from the close here back on July 28th, that will be some resistance, as well as this trend line coming down from the top, which coincides with if we bring up the volume by price, there is this big chunk here, volume by price, at around 67. So this is the next area of interest between 67 and 68,000. Probably hang out there for a day unless it's extremely strong move. We can slice right through that as well. But Bitcoin can move very, very, very quickly. If we go back here and we measure some of these moves, so like the last time we broke up from the 50-day moving average after, well, it wasn't the exact last time. There's 2 other times. But if we take a look at this one, we moved in a matter of like 2 weeks, we went up 70%. Now, I don't know if we can do that again now. So breaking this 70% in 2 weeks takes us way high. Holy crap, takes us past 100K. So I don't think that's going to happen, but it's possible. Anything's possible in Bitcoin. It's extremely volatile in both directions. And so, yeah, if we take a look at this one, this did the same sort of thing when we bounced off here and found support. This took a little while longer from October to January. So 3 months, we went up 80%. I think everyone would be happy with 3 months and 80% from this point. We are all used to this price range now. One thing that I've been writing about recently is that when we get these big jumps in price, it takes a while for people to get used to this new area. Like, coming up on 30,000, we got used to this being a base, and then it went up. Now we're here. We're kind of used to 60,000 being a base now. And so that gives more psychological room to the upside. That's very important when we talk about Bitcoin and its exponential moves that it has. If we bring up the MACD and RSI, very simple indicators, just got to stretch this out here. You can see that, hide some of these so it's more visible. Stretch out the price so we can see. So RSI is breaking out, plenty of room to go before oversold. We got another week's worth of price action, probably until we get too significantly oversold. Bitcoin isn't really oversold until 80 on the daily. I mean, you can count it at 70, but 80 is a better mark because Bitcoin can just continue to run higher. But this was an important one that we've been talking about for a while. This divergence on the MACD. We did not get a divergence on the daily, but we did get this divergence on the RSI. But we did get it on the MACD, opening up nicely, very, very bullish to the upside, plenty of room to go. The stance is very, very bullish. And with the weak kind of structural resistance, we could make a significant run. And there's all those liquidations up there at all-time high. And the whales are looking at that. They're salivating over the all-time high liquidations. And so that's probably what's going to come next. Now, some other macro stuff that I wanted to take a quick look at before we get into Jay Powell. The dollar sold off again pretty heavily today because of Jay Powell's comments. However, I don't care about the MACD for this one. However, when we take a look at the RSI, we could be forming a bull div on the RSI, a very short time frame bull div on the daily, just a matter of 3 days and get a bull div. That would be a lower low in price, but a higher low in RSI. This is very oversold for the dollar. You have to go back all the way to July of 23, and then back to December of 2021. And there's a couple there in late 2020, March, of course, June of 2020, July of 2020, December of 2020. So not 2021, December of 2020. But this is significantly oversold for the dollar. I don't think we can continue selling off here. Also, in a recession, we go into a dollar shortage, not into a dollar surplus. So this is most likely near the bottom. Stocks, real quick. Plenty of room on trying to get back to all-time highs. Had a good day today off of the Powell reaction, but it's behaving exactly as I expected here and as I called back here at the lows. I mean, almost to the hour I did the live streams and stuff. Let's see, August 5th. Make sure that's a live stream day. Yeah, that was Monday. So I was live streaming then, and I'm saying this is oversold. We're probably going to bounce, and all-time highs are very soon. Wrote about that twice in a row, Monday and Tuesday of that week, that S&P was going to go back to its all-time high, and it looks like that is the case. 10-year, real quick. Selling off here a little bit today, but well above the lows. So we'll see how that goes. All right, so that's all the charts, all the macro. One more time, let's take a look at ETH. ETH BTC. I mean, this is ridiculously bad. If we bring up the 20 period, that's really holding it down right now. Just so incredibly weak. ETH is getting trashed. Now, before we go to Jay Powell, let's take a quick look at these flows. And of course, it has not been updated today. And these are the Bitcoin flows. And you can see 6 days now in a row of positive flows. Not very significant, but they are positive, all under $100 million. So that's good. That's consistent inflows into the Bitcoin ETFs. If we go to the Ethereum ETFs, we see just the opposite, consistent outflows over that same period. ETH is just looking bad. They're down to over $450 million in outflows. When will that stop? Nobody knows. Okay, let's go to Jay Powell now. Okay, but before I do that, let me take a look at the comments. Dex Invictus back with us. Raul Boss says, also testing the 221 weekly MA. Let's take a look at that. No hate on that. So go to the weekly. I don't have that plugged in to my, actually, you know what I can do? Go to the daily. I have this one set up for, that is the 20, no, that's the 50 week. Let's go to 21 week. Okay, there's the 21 week on the daily chart. Yeah, very interesting. I don't know how many people use the 21 as a measure. Usually you would use the 20. And 20 is right there, obviously, as well. So that is a big one. Very, very interesting what's happening there. Okay, back to Jackson Hole. And 95 people watching. Hey, guys, what's up? Like, comment, subscribe. If you're on Twitter, jump over to YouTube or Rumble. Like, comment, subscribe over there to help the algorithm. I appreciate that. Trying to get the YouTube monetized. Also, check out the website, bitcoinandmarkets.com, and Telegram at t.me/bitcoinandmarkets. If you're watching on YouTube or Rumble, all those links will be down in the description, or at least they should be. Okay, let's maximize this for Telegram, and I think the levels will be good, but I'll check them as we play. So it could be loud right off the bat, just to warn you. So let's go.
But before we get to any of that, I am delighted to say that we have Federal Reserve Chair Jay Powell here to deliver opening remarks.
How's that volume, guys?
So with that, let me welcome Jay Powell to the podium.
Jay Powell. Jay Powell.
Thank you, Karen, and thanks to our hosts from the Kansas City Fed. It's great to be back here today. 4.5 years after COVID-19's arrival, the worst of the pandemic-related economic distortions are fading. Inflation has declined significantly. The labor market is no longer overheated, and conditions are now less tight than those that prevailed before the pandemic. Supply constraints have normalized, and the balance of risks to our two mandates has changed. Our objective has been to restore price stability while maintaining a strong labor market, avoiding the sharp increases in unemployment that characterized earlier disinflationary episodes when inflation expectations were less well anchored.
Okay, so if you guys are watching this, you probably know that they have a dual mandate. That dual mandate is full employment, maximum employment actually is the wording, maximum employment, and stable prices. So they have, their mandate was out of balance because they didn't have stable prices. So they had to put all hands on deck for the stable prices side of their mandate, and while keeping an eye, but not really caring too much about the employment side of the mandate because unemployment was doing so well. That has changed, and so what he's saying is bring it back into better balance. That's the terminology they've been using on their statements for the last several meetings. And yeah, so far it's just boilerplate. He seems extremely relaxed, just on a personal note here. Usually he's a little bit more engaged. Here he's kind of looking a little sluggish, maybe he's tired from the 3 days of meetings, however long it was, and this is what he has to get up here to do at the end of the Jackson Hole meeting. But yeah, let's continue.
While the task is not complete, we have made a good deal of progress toward that outcome. Today, I will begin by addressing the current economic situation and the path ahead for monetary policy. I will then turn to a discussion of economic events since the pandemic arrived, exploring why inflation rose to levels not seen in a generation and why it has fallen so much while unemployment has remained low. So let's begin with the current situation and the near-term outlook for policy. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. The FOMC's primary focus has been on bringing down inflation, and appropriately so. Prior to this episode, most Americans alive today had not experienced the pain of high inflation for a sustained period. Inflation brought substantial hardship, especially for those least able to meet the higher costs of essentials, like food, housing, and transportation. High inflation triggered stress and a sense of unfairness that linger today. Our restrictive monetary policy helped restore balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remained well anchored. Inflation is now much closer to our objective, with prices having risen 2.5% over the past 12 months. After a pause earlier this year, progress toward our 2% objective has resumed. My confidence has grown that inflation is on a sustainable path back to 2%. Turning to employment, in the years just prior to the pandemic, we saw the significant benefits to society that can come from a long period of strong labor market conditions. Low unemployment, high participation, historically low racial employment gaps, and with inflation low and stable, healthy real wage gains that were increasingly concentrated among those with lower incomes. Today, the labor...
So overall, the economy was doing well, but it was not booming. And one of the things, Emil Kalinowski that used to co-host with Jeff Schneider, I think he coined this, the silent depression. And when you have growth of 1 or 2%, or even say 3%, 4%, but most of that growth is financialized growth. So it's financial assets that are growing. The younger folks, a whole generation, will feel disenfranchised. They'll feel that they aren't getting a shot at the American dream. And since the great financial crisis, that has just gotten worse. And from COVID, that has just gotten worse. So the headline numbers, we talked about this the other day about GDP being the king of macroeconomic indicators. GDP does not tell a complete story. It really, for really good macroeconomic analysis, we're going to have to move away from GDP somehow, or at least tweak it or fix it, because GDP does not measure the health of an economy. Just look at birth rates. People are putting off getting married, they're putting off having kids, and then it's too late. Population is crashing all over the world, and that doesn't happen in a healthy economy. That doesn't happen in a healthy society and healthy culture. So yes, the numbers have been good, relatively speaking, but for a generation, they haven't been doing as well as they need to be doing. Okay.
The labor market has cooled considerably from its formerly overheated state. The unemployment rate began to rise over a year ago and is now at 4.3%. Still low by historical standards, but almost a full percentage point above its level in early 2023. Most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen.
So that was a big quote. The slowdown in employment situation is unmistakable. That's a very, very strong, blunt statement that we don't usually hear from Jay Powell. Usually the Fed chairman, they dance around things. They say we need to wait on data. The data suggests this. We think we need more data, yada, yada, yada. Okay. You never get a straight answer for them. But this was a very straight comment, blunt comment from Jay Powell, which probably is setting us up for something here coming shortly, because that tone is it's refreshing. It hits you in the face a little bit. If you're not used to listening to this, it probably is unremarkable to you. But if you're used to listening to Jay Powell, that was unlike him. It's unlike other Fed chairmen that have come before. It's very, very blunt and honest. Now, for a long time, I've said that Jay Powell was a straight shooter, and that he was much, much better than Janet Yellen, much, much better than Ben Bernanke. He was a straight shooter. And so I like listening to him versus, I mean, if Janet Yellen right now was the Fed chairman, I would not like to listen to this stuff. But with Jay Powell, you get this sense of him, that he's genuine. And so, a lot of people like to just criticize the Federal Reserve. I fall short of that. I don't think they're super necessary, but they do psychologically sway the market. And we're going to take a look at a post that I wrote today that kind of goes through that a little bit. And so that was the first really blunt statement.
Ratio of vacancies to unemployment has returned to its pre-pandemic range. The hiring and quits rates are now below the levels that prevailed in 2018 and 19. Nominal wage gains have moderated. And all told, labor market conditions are now less tight than just before the pandemic in 2019, a year when inflation ran below 2%. It seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. We do not seek or...
So that's kind of an interesting comment. So the one thing that they're worried about to get a handle on inflation, quote unquote inflation, is price rises. This is not money printing. To get a handle on their quote unquote inflation is they worry about employment that's too high. So if you have a 3.3% unemployment rate, that's a very tight labor market. What happens in that situation? Usually wages go up. Higher wages threaten to kick off a wage price spiral, causing more and higher sustained price increases. That's one thing that they're worried about. So to keep that from happening, they raise rates. So their whole thing is to, over the last 2 years, has been to tamp down the employment, really honestly cost people their jobs. And he's been grilled on this by the different committees that he goes and sits in front of with the congressional oversight committees. And but that's exactly what they're doing. They know that they don't want wage price spiral. And he's saying right here that risk is pretty much gone now. There is no threat. There is no threat at all from a wage price spiral.
Welcome further cooling in labor market conditions. Overall, the economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come.
So before he says this statement, the risks are swapped now. The risks are towards recession and unemployment versus inflation and high employment. And I'm going to go back a couple seconds because this is the important statement of the entire thing here.
To both sides of our dual mandate. The time has come for policy to adjust. The direction.
Boom. That was the big one that everyone's talking about. If you were in the room, you probably felt something. Maybe some people were sighing or gasping or whatever, because that is extremely blunt. He's basically signaling that it's time to cut rates. So they are going to be cutting rates in September. The only question now is if it's going to be 25 or 50.
Of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there is good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market.
We're going way under 2.
The current level of our policy rate gives us ample room to respond to any risks we may face, including the risk of unwelcome further weakening in labor market conditions.
It's going to happen. Recession.
So let's now turn to the questions of why inflation rose and why it has fallen so significantly even as unemployment has remained low. There's a growing body of research on these questions, including Gowdy Eggerson's work, which we'll shortly discuss. And this is a good time for this discussion. It is, of course, too soon to make definitive assessments. This period will be analyzed and debated long after we are all gone.
Okay, so now they're talking about the inflation and where did the quote-unquote inflation come from. You guys know my position. My position is that we didn't get inflation after the GFC. And a lot of people a lot of Bitcoiners, a lot of gold bugs, a lot of Austrians, they will say, hey, that this is because it was stuck in the financial system somehow. It was stuck in the financial system. Of course, that's not the case. The case is that credit creation slowed down, and they were trying to paper over with new assets that they called reserves, and with a new process that was called QE. I mean, it wasn't a new process exactly, but it was new in the modern era in the United States. And that didn't stimulate. That it was meant to stimulate the banks to lend more, and it did not do that. We are just grinding down in a deflationary bubble, at the backside of a deflationary bubble, as it's popping in slow motion. And so then along comes this pandemic, and you have supply chains getting cut everywhere, okay? And people locked inside. So people shifted their demand from services because there were no services, that nobody could go to the barber. I mean, some people could, but few people could go to the barber. Few people could go to the dentist. Few people could do, the services that they needed. And so people's spending switched from services to goods. And what happened to the supply chain? The supply chain to move those goods stopped. And so all of the prices just went through the roof because demand shot up, and it was boosted by federal spending, the stimmy checks. So demand shot up and supply withered away to nothing. If you guys remember, you would be on back orders for things for 6 to 12 months. Wouldn't be a good time to have to replace your refrigerator or your dishwasher or something like that, because you would be waiting for 6 months to a year just to get those things. I know people that were in the middle of remodeling or something their house, and they couldn't get the materials just to finish the projects that they already started. And so that was the biggest driver of inflation, because it wasn't the response from the Fed, it wasn't QE, and it wasn't fiscal spending alone. It was all these things together. And the key piece was the lockdowns and the supply chain stuff. That was the key piece that actually lit the inflation. But what he's talking about here is academics are always behind, especially from the Federal Reserve. And so he's talking about, he's just going to explore some of these ideas. And that's all we really have to watch of this. You guys can go watch those ideas. He says, hey, he labeled it transitory wrongly, and I disagree. Transitory was the right call. His time preference was just too high. He was expecting transitory of a year, and it was 2.5 years or something like that, or 2 years. And now we're just starting to see that slide down on the backside. Inflation peaked in June of 2022. So anyways, let's see, where do we go next? Let's go to the website and read. This is a post I put up this morning. It goes out free, so you guys can make sure you're signed up for this so you don't miss any of this. And actually, before we go into that, let me check any comments. BTCB, standby. My boy. That was my son coming in here and bothering me. Okay. BTCP says, do you think the stimmy check approach will be something the government does again in a recession? That's a good question, man. Probably not. I'm thinking back to George W. Bush, and he put out a $1,200 stimulus check, if you guys remember that, during the Great Financial Crisis. And then this one, they did it again with COVID, and those were very significant ones. Probably they will do something. Depends. Right now, actually, the U.S. is economically, it's in a really weird place. Like, the economy is obviously slowing down, but look, if rates come down very quickly, which I kind of expect them to do, what else is going to come down? Interest rates for mortgage rates. And so people are going to rush to refinance. People are going to rush out and buy that home. There's a lot of pent up demand, especially in a recession. People are going to rush to refinance. They bought it at 6-7%, and they're going to rush to refinance it at 4%. And so that's a lot of extra money coming into the system. They might not have a lot of equity saved up. Maybe they will, because prices might start turning around very rapidly. They've fallen 20-30% in some places. They might turn around rapidly, give people a little bit of equity to refinance and take out. So they can, there could be a big stimulus just from that respect. And so there is a possibility that this recession is relatively brief. It could be deep, but it might be brief. And the U.S. is set up very well. If Trump does get elected and he drills, oil prices go down, that's going to be a stimulus to the economy as well. Give people more room for discretionary spending versus spending on necessities. So there are some things lined up here. Also, if Trump comes in and has big tax cuts, that's going to be really big deal as well. So I don't know if they're going to do a stimmy check, but I do expect there to be some major changes here with the supply of money over the next 6 months, and it could be quite stimulative and pull us right back out of the recession. Raphael, Ansel, as far as the yen carry trade, isn't the same effect if U.S. lowers interest rates as if Japan raises rates? Yes, but I am not one that buys into this yen carry trade unwind. It's a $20 trillion trade, and maybe a couple billion got unwound, 10 billion, 20 billion, something like that. It was not any significant portion of the yen carry trade that got unwound. There's still a huge spread between Japanese yields and foreign investment opportunities right now. And so that will affect the yen carry trade. But they might, if they start going, if this affects Japan and they start going into deflation as well, they're going to drop their rates to zero. So that fixes that whole problem. I'm not worried necessarily about that, to be honest. The thing that, I don't know, Japan is also an interesting case because of their demographics. They're kind of like a dead country walking. They have about 10 years left of real good economic activity. a lot of the yen carry trade is those old investors that they put money into products, and those products will then invest in foreign assets using the yen carry trade. So, yeah, I don't see the demand for the carry trade decreasing. I just see kind of Japan's economy just stagnant for the next 50 years. And they could really hit a wall in the next 10 for sure. Dex Invictus, interesting to see how this affects the agricultural mortgage markets. Yeah. Do you have experience with that, Dex? I don't know much about agricultural mortgage markets. You're talking about like buying farms and mortgaging the farm to plant for the season and something like that. I don't know much about that market. Raphael, because the reason for the over leveraged trade is the delta between, yes, that is the case. But again, I think it would still be healthy at 2% spread. So, if the 10-year got down to 2% and the yen was at 0.25, I think it would still be a legitimate trade there for them. Dex says he's invested in a company that does that. Interesting. Yeah. I think it will apply to that too. I mean, mortgage rates are going to come down for everybody in this scenario. And so that's going to be a big source of stimulus for people. So land prices might go higher, much higher. But remember, the overall overarching theory here is that we're the end of a 75-year bubble, and it's trying to deflate. It wants to be, -2, -5% deflation, actually, because it wants to deflate and have creative destruction and fix itself. But it's not able to do that because the Fed does balance sheet magic to bail people out. The government continues to spend money, and so they can kick the can down the road. But when they do that, when they kick the can down the road, they cannot fix it. They're not fixing it. We can't return to 5%, 10% growth. On a nominal basis, maybe when we did during COVID, we had a nominal growth of like 10%. But we're not going to be able to escape the inevitable end of all credit bubbles, and that is deflation. So that is the overarching pressure. That's kind of the climate that we're in. And yeah, inside of a climate, you can have periods of drought, periods of wet, periods of hot, periods of cold. So we can go through different stages, but the overall climate is the end of a deflationary credit bubble. And that's most of my content is diagnosing that exact phenomenon and what is going to happen. What does the role of realpolitik and international competition, what role does that play? We're getting all of the top like Indian graduates. We're getting the top graduates from around the world. They're coming to the United States. That's one thing that's going to save the United States economy versus other economies. I mean, just think out of the top 1% of graduates in many countries now, at, I don't know, 25 to 50% leave. If you were in a poor country, would you want to stay? Or would you want to go and become wealthy in America? And so a lot of people, that's one of the problems with El Salvador. When I did my geopolitical analysis on El Salvador, when they adopted Bitcoin, I think it's going to be great for them. I said they could double their GDP in 10 years. That would be a great outcome. But they have this major brain drain problem. And the brain drain, the top people leave and go to Mexico or the United States, period. They send a lot of remittances back home. I think, if I remember correctly, it's like 25% of their GDP is remittances. And so the top people always leave. And that's going to spread around the world. Everyone's going to be like that. I mean, some places that are a little bit more patriotic and stuff. So the top Russian people might stay in Russia. The top Egyptians might stay in Egypt. They might, I don't know, maybe at a higher percentage, but a lot of them do leave. A lot of the best Iranians, best Egyptians, best Indians, best Chinese. Japanese pretty much, I think, stick around, but there's not very many. There's, a shrinking number of them to actually emigrate. But the top people leave. And the U.S. doesn't get all of them. Some of them go to the UAE. Some of them do end up like in Europe or something. But a very, very sizable portion of them end up in the United States. And that's going to buoy the United States economy. So anyway, I got on a tangent there. Okay, let's go into this piece. This piece is what I put out this morning, the Fed's illusion of control. And I read this tweet from Peter Brandt this morning. And he said, my problem with the Fed is not so much that it causes volatility, but that the Fed has a pattern of too little too late. The entire Fed board is made up of incompetent PhDs with no market sense. So this is one of the ideas that I push back on all the time, because it's the way, I think it is the viewpoint, it's the vantage point, or it's the way that the idea that they have, the how they view the Fed is wrong. And so anyway, I had to respond to this, and let's see what I wrote. So I said, spread of misconception. Oh, by the way, you guys can get a free month if you sign up using these links. Member, the $5 member or the $15 member, check those out. Okay, spread of misconception. You probably heard this quip: the Fed is always behind. They never see the recession coming. And I'm guilty of saying that for many years. Not the last, 6-7 years, I haven't said that. This critique often targets the PhD economists at the Federal Reserve. One thing that I've targeted the PhD economists is trying to say it's quantitative, like quantitative easing, but they just do, blocks of 25 basis points. It's not quantitative if you do blocks of 25 basis points. Anyway, so I have been critical of those PhD economists as well, questioning how, with all their expertise, they fail to predict economic downturns. But hidden in these remarks is a fundamental misunderstanding that the Federal Reserve wields omnipotent control over the economy. That is a fundamental misunderstanding. This myth is encapsulated in the mantra, don't fight the Fed, which is wrong. Okay, the Fed doesn't fight the market. That is what you should think. Not the don't fight the Fed, but the Fed thinks don't fight the market. If you just twist it on its head, you got the right answer. The widespread belief of the Fed's omnipotence likely stems from two sources. First, Wall Street's psychological scars from when Paul Volcker took the Fed's helm, hiking rates 20% to 20%. So the peak was in June of 1981, followed by the severe 81-82 recession. This was the most severe recession since the Great Depression in 1981-82. And then, of course, the GFC was the most severe. It took the mantle of most severe recession since the Great Depression, 40 years after this one. Second, influential economic schools like the Austrian School and the Chicago School, with figures like Hayek, Mises, and Friedman, have long critiqued central banking, viewing it as an antagonist to free markets. An idea popularized further by figures like Ronald Reagan. So we have professionals scarred by the 81 events and academics painting the Federal Reserve as all powerful. But what if I told you this isn't the case? What if the Fed's influence is more about psychological manipulation than mechanical control over the economy? Reality of the Fed. So then I say this morning, this is the one why I wanted to write this. Brandt, who began his successful commodities trading career in 1976, epitomizes the mindset I've previously discussed. The common oversight here, shared by Brandt and many others, is that the Fed isn't late or doesn't fail to predict recessions. Okay, what was that sentence? The common oversight is that the Fed isn't late and it doesn't fail to predict recessions. It's that the Federal Reserve simply isn't in mechanical control. So if you look at his chart, he's showing like, rates are going up. They should have raised rates before this. Why didn't they raise rates before this? Well, because They aren't in control of rates. Rates go up. And then now they're falling down. And he's like, now they're late to cut. So they're always late. They're always behind. But that's not the case. They just follow. And if you take a look at a long-term chart here, this is going back to that 1981 period. Rates fell. Rates never got that high. Market rates, they never got that high. They pulled down on this, and the effective Fed funds rate came down. Same thing happened here by a few months. Rates started falling. Policy peaked and then started falling. Here you can see market rates in white started falling, and then the Fed started cutting. Here, same thing, peak, falling. Policy rate did not peak till a couple months later and then started coming down. Continued, it fell through the policy rate, and then they followed it down. Then it bottomed first and came up, topped first, came down. See, if you just walk through all of these, all they do is follow. In the modern era, since Volcker, all they do is follow. They do not control anything. The chart is clear on this. Historically, market rates have always led the charge. The chart above illustrates instances where market yields dropped, prompting the Fed to either pause rate hikes or follow the market's lead downwards. So they paused, then they had to follow. Paused, then they had to follow. Okay. The same pattern holds when yields rise, although these instances are less pronounced but still evident. Yields bottom first, with policy rates following suit. The 2016 anomaly where we'll cover that when we get to it. So you can see yields bottomed, went up. Policy kind of came up, but was really flat in this middle area, while market yields were much higher and staying up. Once it looked like they were staying up, the Fed came up with them. Okay, here yields turned around, started coming up, and the Fed was flat here originally, and then it started coming up with it. Here yields bottomed, came up, Fed was flat about halfway through, then they started coming up. Here, this differential right here, yields never obeyed the Fed to come down here. They bottomed right at the beginning of this box, and they were flat to higher through this area. They actually cut here when yields went up, and they were flat. Then they finally started chasing, coming back up to where the market was. And this one recently, before 2020 or after 2020, we can see that yields were climbing. The Fed was flat and then finally followed. Okay, then they overshot. But this was the anomaly, the anomalous one here. So markets unsure Fed could end ZERP. They didn't know if the Fed could actually end their zero interest rate policy. And the 10-year kind of traded range bound for a long time until the wheels came off in 2019 or late 2018, I think it was. So, but I can explain that. That's the 10-year, and the 10-year is the reason I selected it was because it had the data on TradingView back to Volcker. The 2-year did not. But if we examine the 2-year, it clearly shows during this anomalous period, it was rising before the Fed started raising. And if we look here, we can see the 2-year started rising during that same period when the 10-year was unsure, because the 10-year is looking at future growth and inflation expectations. And so it was unsure about future growth and expectations, but the 2-year was moving higher. Okay, the 2-year is moving up way before the Fed cut, a whole year before, raised rates. The 2-year started moving a whole year before the Fed raised rates. So again, the market is in control here. I said, conclusion. In essence, the Federal Reserve, despite its significant influence, does not dictate market rates, but rather reacts to them. So it's backwards from what Peter Brandt is thinking. This dynamic underscores a critical truth. The Fed's power is aimed at psychologically guiding economic sentiment. Sentiment, important word, rather than controlling the economic machinery outright. They are a psychological operation. This perspective challenges the nearly universally held belief that in the Fed's omnipotence, revealing instead a central bank that follows rather than leads the complex currents of market dynamics. So there you go. Check it out. Become a free member over there on bitcoinandmarkets.com. And let's check the comments, and then we're out for Friday, guys. Out of the week. I'm just checking here, Raphael. Because of the reason. I addressed that one. Dex Invictus, I'm invested. Oh, I reacted to that one. Do you think the Fed funds return to zero or ZERP again? I think it will. I think it will. Now, will it in this recession? That's probably not going to be the case. Let me go back in here and look at that chart. They raised rates so much here recently. They're so far extended. They're going to come down dramatically. I don't know if they get back to zero in this recession, but they will in the next recession, whenever that is. And we probably will start seeing more faster recessions. So this period here from the great financial crisis to COVID, really COVID, we were going into recession before COVID hit. And there was even some conspiracy stuff back then talking about COVID was just a ruse to cover up the coming recession and blame it on something else. I don't think that was the case, but we were definitely going into recession when COVID hit. And so it kind of got delayed by COVID and the policy response to it. And are we just seeing a resumption of this previous recession that we should have had now? But this whole period, like 12 years or something, I don't think it's going to be that long between this coming recession and the next recession. I think it's going to be shorter, like 5 or 6 years, because we're getting to the end where the can kicking can't get any growth. And when you can't get any growth, you have riots on the streets. Okay, so we're going into a period where low growth, low inflation, rates probably close to zero in this recession. If not at zero, it's possible. But I think it probably will happen in the next one. Okay. The interest rate fallacy is real. The stock market goes up higher when interest rates rise. Counterintuitive stuff, kind of like Bitcoin. Yeah, very good point to bring up the interest rate fallacy. Remember that the interest rate fallacy from Milton Friedman, that as rates come down in tight economic times. A lot of times people think, or the common knowledge out there is that if you lower rates, it's stimulative because people will take out more loans. Now, this does, like my whole thing I just talked about, the housing market, it does work in some sectors, housing being one of them. But overall, for like businesses and things, the reason why rates are falling is because people can't afford higher rates. Business is bad. And so they can't afford the higher rates. Rates come down naturally. Banks don't want to lend, really. We talk about this when we look at the SLOOS reports that come out on a quarterly basis from the Federal Reserve. It shows that banks they not only tighten lending standards, but demand falls. As rates fall, demand falls, and lending standards go higher from the banks. So when rates are falling, that's tight economic times. And where Bitcoin would fit into that is if Bitcoin is going up, that's liquid money right there. Also during those times, so as yields are falling, we're in a dollar shortage when yields are falling. And Bitcoin's a rally in Bitcoin. Like even now, we have TradFi is in Bitcoin now. They're invested about $20 billion into the ETFs, and TradFi if Bitcoin goes up and they sell, they get that gain. That is dollars in a dollar shortage period. So, Bitcoin going up in value is another thing that's going to maybe be able to stem the recession tide. So the U.S. has most of the Bitcoin and a lot of the, not a majority, but I think it's the largest mining country. That's debatable because China supposedly still has a lot of miners, but I don't know how that's possible right now. So the U.S. has a significant amount of mining. They have a significant amount of the Bitcoin business. They have a significant amount of Bitcoin in general, and it's just going to get more in the next several years. And so as Bitcoin goes up, that's actually going to help the U.S. economy relative to other economies, right? And so I don't know, that would be an interesting thing to watch, and how that is affected by interest rates. Yeah, so that's what I have to say about that. All right. Okay, check Telegram, see if there's any comments over here on Telegram, and there are none. So that's it for this week, guys. Thank you for joining me. Make sure you sign up at bitcoinandmarkets.com. And if you're watching on Twitter, jump over to YouTube or Rumble and like, comment, subscribe over there. I try to answer all the comments. I'm not the best at answering the comments over there, but it helps the algorithm, and I'm doing my best to become better at checking those comments on a regular basis. So appreciate everyone that's watching today, and have a great weekend. Get outside, touch grass, talk to those people that you love. That's what's really important, is human contact, human interaction. So thank you guys. Have a good weekend. Bye.